Welcome to Insights Over Coffee, the podcast where we cut through the jargon and look at what really drives markets and investing. I'm your host, Sahhar Saleh, and today we're driving into a corner of the financial world that has grown tremendously over the past decade: private debt. In our previous podcast, we unpacked the surge in gold buying from a central bank accumulation to retail demand and explored what was pushing the metal back into the spotlight. But today, we shift from the safety of gold to an asset class built on lending, leverage, and long-term credit management. Private debt has expanded rapidly in recent years, fueled by low interest rates, institutional demand, and the search for yield. But with growth comes complexity and hidden risk. We're joined once again by Ilias El-Bahraoui, Head of Asset Management at Lake Geneva Investment Partners, who will help us unpack how the private debt landscape is evolving, what rising scrutiny means for lending practices, and why investor psychology from confident to caution may be one of the most important cycles to watch going forward. And as always, stay tuned until the end of the episode for our segment, Signal or Noise, where today's headline in private debt reflect a real structural shift or just another moment of market overreaction. Now, a quick disclaimer. This podcast is for informational purposes only. Nothing here should be taken as financial or investment advice. Please consult a licensed financial advisor before making any trading or investment decisions. Now, maybe let's start with a bit of history to better understand where we are today. How did we go from an unheard corner of the market not that long ago to the large size of this market today?
Hi, Sahar. Thanks for having me once again. Private debt or private credit has always been around to a certain extent. Back in the day, the private debt market meant only one thing. It basically meant private placements. So dating back almost 100 years ago, private placements are the issue of debt or equity securities by a company to an investor or even a group of investors in a private and bespoke transaction, as opposed to the better known and highly regulated public markets. So private placements normally have maturities between 5 and 15 years, if you will, beyond what most banks are willing to lend. They are unrated by the large rating agencies like S&P, Moody's, and Fitch. They almost always have fixed coupons. So if you look at the US, for instance, which is the largest market by far, especially when it comes to private markets, until the late 70s or early 80s, both the public corporate bond market and private placement market focus solely on investment grade companies. Then, of course, the public high yield corporate debt market came into existence to provide generally smaller companies that were non investment grade with the ability to access long term fixed rate debt financing, often unsecured. However, since this market was public, there are several drawbacks, including access costs, the requirement to have credit ratings. What else? Compliance with the stringent regulators' reporting requirements and necessary disclosures, which can be pretty painful, and of course a minimum size of issuance, which is generally not much less than 100 million US dollars. So for all these reasons, the public high yield market was unable to meet the needs of smaller companies that required less than 100 million US dollars in financing and that were too small to be public anyways, or actually wish to remain private sometimes. Hence, a private market alternative began to develop, known as the mezzanine market, where early investors were mainly insurance companies, SNLs, and actually later in the 90s, you really had dedicated mezzanine funds. So if we fast forward into right now, 2025, the private debt market grew tremendously by size and also strategy and the number of existing funds as really regulations enacted after the global financial crisis. They enacted the fact that basically they pushed traditional financial institutions out of the business of lending and providing loans to commercial and industrial smaller businesses. So, to give you roughly a few figures, now the size of the private credit market in the United States is actually bigger than the US public high yield market. I think we're talking 1.5 trillion for the public markets in high yield in corporate United States versus over 2 trillion in the private credit. So you had this exponential growth post the global financial crisis, and naturally now private credit really became a pretty much every day you're going to read articles on the major financial news outlets talking about different things, around the sector.
And what triggered this exponential growth in private debt post 2008?
Well, after the global financial crisis, we really had an ideal environment for private debt to foster. On the one hand, we had, for an extended amount of time, zero interest rate policies, both in the US, also in Europe. Actually, in Europe, rates went even negative. We had high credit spreads, especially in the second half of that decade, from 2010 to 2020. And then we had so the result of that, we had extremely cheap money. Leveraging was very attractive because it was cheap. And all this actually made people venture into more and more into private markets, especially at a time when returns, one can argue, on government securities was extremely low on the fixed income side, because again, the yield curve was sort of compressed by the actions of the central banks. Hence, people were looking for yield. There was definitely a chasing yield phenomena that was occurring, especially 2015, 16, when yields were really low. And actually, private credit, if you look at the performance of private credit from 2008 to now, some of the portfolios managed to match the performance of the S&P, which has done tremendously well. So we're talking about an annualized return of 15, 16% for some private debt portfolios, which is incredibly attractive. So people were willing to give up liquidity to get these sort of returns. One sector that we track, or one corner of the market that we track, is called business development companies. Business development companies are basically, you can see them as portfolios of private equity or private debt. And the BDCs are actually securities that are traded on the stock market. You can just buy them like a stock or an ETF, and they trade every day. They're generally very liquid. Some of them are very large and issued actually by large companies such as the Blackstones, the Goldman Sachs of the world. And you can see, so basically BDCs represent 3% of the 2 or 3%, at least publicly listed BDCs represent 2 or 3% of the size of the private debt market. So an extremely small portion of the market. However, it gives you a bit of an idea of how the sector is doing to a certain extent, even though it's the tip of the iceberg. It gives you an idea how the sector is doing. And if you look at the performance of some BDCs, they've done incredibly well. And they have a high dividend yield, which is very attractive with some kind of investors who like their income. And some of these names are trading at actually a very high premium, which means there's a large demand for these vehicles.
Okay, well, this brings me to my next set of questions. Can this trend continue? And if not, what are the changes of having disruptions in this corner of the market? What are your concerns? Do you think that this expansion has changed the quality of deals being done?
Do I think the trend will continue? I personally think it's unlikely, just simply because trees, they don't grow to the sky. We had, as I just mentioned before, a tremendous outperformance of private credit relative to publicly traded high yield, for instance. We've had an ideal environment that generally doesn't last forever. As we know our system is based on cycles, on credit cycles. We had a relatively long cycle, which was sort of extended, especially as COVID happened. There was a lot of surplus of liquidity. Governments basically bailed out the private sector, but also households. So liquidity was extremely, available. Hence, I doubt that this environment actually can go on for much longer. So the odds are not necessarily good right now for private debt, in my opinion. In terms of concerns, I mean, yes, there are many concerns that I personally have. I mean, we can mention a few, but if you look at, again, we mentioned, the outperformance that was quite kind of amazing. But on the other side also, and this ties to your last question, which is the sector has received so much money lately that there is a bit of a sense of deja vu, in the sense that history does not necessarily repeat itself, but it rhymes. And just to quote Mark Twain, if we look back at the subprime crisis, definitely not saying this is the same, but we basically, money started going into borrowers that can actually afford housing. But then, because the whole exercise was going really well, lenders started tapping into subprime borrowers, and that how basically we went from a good credit assessment to looser and looser, we start loosening our criteria, and we ended up with bad credit in our books. And I believe that, and this is a natural phenomenon, when there's so much money coming into a certain corner of the market, which has kind of been the case for private debt, at some point, private credit managers, they're going to start actually giving money to perhaps some borrowers that would not have received that money 5 years ago, simply because, there was not that much money around. So I definitely think there are not a very good amount of loans out there. That's for sure. We've started actually seeing the first cracks in the market. First Brand is one of them, Tricolor. We had Renovo, which was in the BlackRock portfolios. So to mention on the cockroaches that a few people in the industry lately kind of use. One of them is JP Morgan CEO. Yes, actually there are a few accidents that starting to happen. I think it will likely continue. It's not an isolated case. We need a bit of a cleanup in the system. We need the bad credit to go away. We need fragile companies to sort of default to a certain extent. Okay, so in terms of concerns and potential risks, I think while the combination of good performance and the absence of volatility on non-listed private debt funds has compelled many investors to increase their allocation, especially in the context of non-performing public fixed income markets, there are some risks that are much less talked about, and that can turn out to be a serious disruptor, as higher rates are likely to stay around for longer and a potential economic slowdown is around the corner. So, for one, from the borrower's perspective in private credit, the cost of servicing debt has gone up significantly in a very short amount of time. I'm really talking about when we had the inflation problem in 2021, and the major central banks in the world had to raise rates. So remember that it's a floating rate market, meaning the 500 basis points rate hike immediately increased their interest rate cost by at least that much, if not more, because this automatically affects their credit worthiness. So many private loans are currently paying rates well in the double digit zone. Then number two, you can think of the returns made in private debt since the global financial crisis. And that happened in the friendliest of environments the sector could have wished for. So free money was abundant, and so was liquidity. This is changing now. The risk-free rate is at 15-year high. Now, of course, it started coming down a little bit, but depending on how the inflation numbers will come in, we'll see how much the Fed or other central banks have, how much leeway they have to lower rates even more. So given the fact that also we can have an economic slowdown in conjunction with inflation returning, this all can put a lot of strain on private markets and private debt specifically. On the other side, I don't see how these generally lesser liquid, lesser quality borrowers can afford to pay 15% interest a year while they're getting hit by headwinds on the real economy. There's also another concern that I wanted to mention is that this sector is growing so fast with so little transparency and regulation. It's very opaque. Very few people have an insight. Regulators don't seem to have that insight, at least for the time being. And we have seen historically what happened to corners of the market that lacked oversight. Most often they did not end well. And the true risks in this sector will not be known until they spill over into the broader economy. And apart from lending to firms owned by private equity funds, there are also newer types of financing making their way in the world of private debt, since cash on hand at PE is near the lowest since at least 2008. So, we can mention the fact that Manco loans or management company loans tend to finance larger commitments from general partners, their own funds, M&As, and buying out other partners. The collateral is often the fund manager's fees and returns from investments. On the other hand, also you have NAV loans or net asset value loans financing growing portfolios, returning money to investors and preventing selling portfolio companies at discount. The collateral is often the capital that investors commit to PE funds. And again, just to reiterate, I think the possibility that the private debt sector receiving more money they can handle is very much real. I think private credit managers will be tempted to grow at the expense of credit quality, as some non-worthy borrowers can benefit from the hype.
Now, before we wrap up, it's time for our tradition here on the show, Signal or Noise. Now, yes, you've been through this segment before, so you know how it works. But for those who are tuning in for the first time, here's a quick rundown. I'll share the headline that's been making waves in private debt, and our guest will weigh in on whether it's a genuine market signal or just noise in the background. But first, a quick disclaimer: everything shared in this segment is for informational purposes only and does not constitute investment advice. For any financial decisions, please consult a licensed financial advisor. So the headline reads: Private credit, promising or problematic? Is this a signal highlighting that despite the risk, private credit still can deliver attractive risk-adjusted returns if managed well, or is the concern overstated?
I think that the short answer is um, problematic at first and promising later. I think we need to go through a bit of a cleanup that we just mentioned, and for sure there are some good solid portfolios out there, very good borrowers that will actually live on.
And that's a wrap for today's episode of Insights Over Coffee. Thank you, Ilias. I hope this conversation gave you a clearer perspective on the state of private debt. If you enjoyed today's discussion, make sure to follow, subscribe, and share it with anyone interested in the changing role of private debt with global markets. We'll be back soon with more conversations on the strategies, dynamics, and ideas shaping the future of investing. Thanks for tuning in, and until next time.
Thank you.